Good afternoon, good morning, good evening, whatever time you're seeing this. My name is Chris Elliott again with Remax Action Real Estate, giving you another COVID-19 update video. Today, I've got Mr. Adam Giroff back again, repeat offender from Geneva Financial. Adam's our go-to lender, partner, preferred lender, whatever we're calling it these days. But anyway, Adam, thank you for coming back onto the show. Wanted to bring you back on. The mortgage space has definitely been shaked up a little bit over the last 30 days with everything going on. And I was wondering, Adam, tell us what the heck has gone on? Yeah, what's happened in the last 45 days in the mortgage space?
Yeah, good to see you again, Chris. Thanks for having me on. Well, there's a lot that's happened in the mortgage space. A couple things, as most people know, rates are still really good, so that's a benefit for the housing market. Regarding the forbearance, go ahead.
Sorry to interrupt.
Yeah.
It's kind of what I do though. So what are rates right now?
It's tough. It depends on the product. And it depends on the day, like we were talking about just a little bit ago. I'd say mid threes is a good just ballpark number for a conventional loan.
Yeah.
So, they're still really, really good. We're seeing a lot of people refinancing, taking advantage of that. And it's a good time to buy because of the low interest rates.
And on the worst case scenario on the high end, what are you seeing?
It's a good question. I mean, high fours, depending on the credit score. And that's what we're going to talk about a little bit further is the different adjustments and different things lenders and aggregators and servicers have been doing to avoid the risk that we're in right now as a market.
Yeah. Which historically, if you look at historic mortgage rates, even at 5%, it's still a good rate. I mean, I know in today's climate, everybody thinks that's terrible, but still cheap money. But all right, well, what happened? I remember we were wanting to get you on the podcast like 30 days ago, and you're like, dude, my head's spinning right now. I can't do this. But what's going on?
So a lot has gone on with the economy in general, and the mortgage market has been reacting to that. A big thing is obviously the unemployment numbers are through the roof, 22 million in the last 30 days, highest ever. With the CARE Act, the government and the media has come out and told people, that you're allowed to do forbearance. Which, in my opinion, if you need it, if you don't have the money to pay your mortgage because of a job loss, it's a good thing. But our concern as an industry is, the government has told people to do this, and people who don't necessarily need to do it are taking advantage of it without knowing the repercussions. So as a consumer, there are repercussions. It depends on your servicer, but they're not necessarily going to report you as a late on your credit report, but they're going to show that there's forbearance on your credit report.
Yeah.
And we've had different aggregators, different people that we sell our loans to come out and explicitly say, if you have a client who is in forbearance, we're not going to do a loan for them in the future. So that's not good. If you're looking to refinance or buy a house in the next couple of years and you do the forbearance and you don't necessarily have to do it, it could really hurt you financially moving forward. As a market, like we talked about a month ago, it was nuts because the mortgage-backed security market didn't have anybody buying these assets anymore. If you think of it, if you're an investor buying these assets, pros and cons, you get to buy it and you start making money after about the second or third year as a servicing company. But if you have a pool of mortgages, and let's say for easy numbers, there's 1,000 mortgages in that pool, and 300 of those people go into forbearance, that pool of mortgage is not worth $1. So nobody was buying those mortgages at the time, and there's still a lot less investors buying those mortgages on the secondary market today than there was 30 days ago. So the whole forbearance and unemployment issue has created a really, really tough secondary market for mortgages right now. There's some of the big boys like Loan Depot. The CEO came out, I think it was 2 or 3 weeks ago, and he was excited because he sold $1 billion worth of mortgage-backed securities at 99, which means 100 is breaking even. 99s meaning you're losing a percentage on that. And he was excited to be able to do that. He would typically sell that at 103, 104. You know, so it's nuts. The mortgage-backed security market's nuts and still reacting to it. And there's been lots of guideline changes and tightening of credit because of that.
Yeah. So just to reiterate, so a couple things. So we talked about it, you know, if you're out there and you've got a mortgage, if you need the forbearance, it's there for you. But if you don't need the forbearance, not only are you hurting the system, so to speak, but you're kind of screwing yourself if you're taking that and you don't really need it. Did I hear you correctly on that?
Yeah, exactly. And there's been a lot of misinformation about that. I mean, I was talking to a good friend of mine 2 days ago, and you know, he's in a great position. He and his wife are still working. They've got money in the bank, but he saw something on his servicing site when he went to pay his mortgage, you know, click here for COVID information. And it basically led him down a path to, well, I might as well. Why wouldn't I do this? It's a good option. And after talking to him, he texted me about a half hour later and said, just made my mortgage payment. Thanks so much. Because there's a lot of ramifications down the road. These servicing companies, it's up to them what they're going to do with that forbearance. So say you go into forbearance for 4 months. Let's say your mortgage payment is $2,000 a month. So after 4 months, there's an $8,000 liability that you have towards your mortgage. The question is, what are they going to do with that? They have an option of saying, okay, you're back. You owe us $8,000 right now. We're going to start default options on you. Or roll it into the back of the loan, or you know, have you pay it back over a year time. We don't know what that's going to be, and that's going to be up to each individual servicer. But it's risky, and it should be being used as a last resort, and that's what it's there for.
Yeah, yeah. So if you're somebody, and I would imagine even if you're somebody that needs to use it, you'll want to clarify that with your mortgage servicer. Hey, exactly, like, how are you going to play this? Am I going to have a balloon payment of missed payments, like, you know, in 4 months, or is that something they can nail down with the servicer before they?
It depends on the servicer. A lot of them are saying, well, we'll reanalyze this once it's up, you know, so you're not really going to get that in writing, I don't think, from the servicer.
Yeah.
You know, they're just going to say, we'll figure it out when it's over. And again, if you need it, I'm not trying to say don't do it, but I think there's a good portion of people who don't necessarily need it, who are looking at it as kind of a free pass to pay off some credit cards or do whatever, and it's not a good thing for that.
Absolutely. And talk to me too, like, I know you and I understand it, and maybe some of our listeners do too. Help us understand the relationship between loan originator, servicer, you know, the mortgage bank. Like, give us an oversimplified picture of why forbearances create a problem with mortgage-backed securities.
Sure. So, kind of process. I'm the first touch on the file, let's say. So I originate the loan, and then my company funds your loan. So we don't service our loans. We're a non-bank lender, right? So yeah. There's different organizations and different ways people have this set up. For us, I originate the loan. We fund the loan through a warehouse line that we have, and typically within a week or two, we sell that loan to a servicing company. So that servicing company then takes over that loan, and they go out and bundle the loans and sell the loan on the secondary market to an investor. The forbearance is an issue from top to bottom, because if I sell a loan today and their first mortgage payment is in June and they go into forbearance in June, that's what we call an early payment default. What that does is it makes that loan non-saleable on the mortgage-backed security market. So the way all the rules and guidelines are written right now, if you have a first payment default, nobody's going to insure that loan. That loan would then come back to us to service moving forward. It's not good for anybody. The servicer loses money. My company loses money. As a loan officer, and this is kind of across the board in the industry, it has been forever. Early payment defaults, we pay our commission back in full. So there's a trickle-down effect when it comes into that. The problem with the CARE Act is it tells consumers, you can go into forbearance. There's not going to be any major repercussions for you, but there's no facility at this point. Apparently they're working on it, but there's no facility to protect the lender, to protect the servicer, as to an exception for what's going on in the economy right now. That's really, as an industry, what we're looking forward to is them working that out. I think if they work something like that out, some sort of facility to take care of these loans that go into forbearance early, it's really going to open up the mortgage-backed security market because there's going to be direction on what to do with these loans.
You seem so excited about the whole situation.
It's a lot. It's uncharted territory. And, you know, again, there's a lot of silver lining on it. I mean, money's still cheap. You know, if you have the abilities to buy a home, I think you can talk on that a little bit. But, you know, in the Richmond area here, before all this happened, there was bidding wars on almost every property. That's not necessarily the case now, you know, so go ahead.
I would tell you, you know, it's been a very interesting phenomenon. There's less sales happening, but what we're seeing, and definitely in certain price points, I would say in the lower third price point, it's almost become more competitive.
Wow.
Because we're actually seeing more sellers check themselves out of the market than buyers. So the buyers that are left, you know, I don't think buyers really care about going in and out of somebody's home. You know, some of them do, of course. But I think it's less of a concern than somebody having their home on the market and having strangers come in and out. But yeah, buyers are having to fight over the inventory that's on the market most of the time, just because there's you know, a lot of folks that just check themselves out.
That's interesting.
Yeah. So, you know, obviously we've got the unintended consequences of, and I'm not saying they made a right move or wrong move, but, you know, the federal government says, hey, you don't have to pay your mortgage. And then the investor that's buying that mortgage says, hey, that's not as good of a deal for me. So they kind of pull back. What are some, talk about some of the maybe unintended consequences or kind of how has this changed the landscape as far as, you know, the mortgage money that's available or what mortgage products are now available or the standards that have changed?
Yeah, so it's tightened up, and it's because of what we just talked about. So that mortgage-backed security market's a lot tighter. Lenders are more concerned about that early payment default. So what's happened is the credit score requirements have gone up, the debt-to-income requirements, so you know, what your monthly liabilities are versus your monthly income, that has gone down. So on the lower credit score files, and this is each company is different, but for us, if you're under a 700 score at this point, and your debt to income ratio is higher than 45%, we're requiring 2 months reserves. So you have to show that you can pay your mortgage for 2 months with available liquid savings, checking account, et cetera. Those are some of the overlays that we have put in to protect ourselves.
Yeah.
And also protect the consumer. I mean, we don't want, I'm sure you don't want to sell a house to somebody who buys a house and a month later is in a bad situation, you know?
No.
So we're trying to protect everybody in doing these things. FHA across the board, for most lenders, and again, every lender is different, credit score requirements have gone way up. We were at 580 before all this. We're up to a 660 for FHA. And again, it's just trying to protect ourselves and protect the consumer, being solvent through this time.
Yeah.
So yeah, it's tightening up. There's lots of products that have gone away from the mortgage market. Non-QM, I know you're familiar with it, but for those who aren't, it's basically an outside the box deal, either bank statement loans or investor cash flow loans, things that wouldn't qualify for a conventional or FHA. Those are gone. Those have been gone for about 3 weeks now. And again, it's just a secondary market thing. There's no desire. Nobody wants to buy those on the secondary market.
Yeah. Let me ask you, I mean, we're all kind of navigating through this, but somebody that's in the business, that's on the front lines, that's, you know, doing this every day, what do you think would be the solution or the way out? I mean, you know, once we get the pandemic under control.
Well, I think the first thing is that facility that the government can help the servicers with, what we talked about earlier. Some sort of guidance on that to protect the investors, so the investors get back in the mortgage-backed security market.
Yeah.
the unemployment just is what it is. I mean, if people continue to lose their jobs at the rate that they're losing their jobs, it's not. If you put yourself in the shoes of an investor, mortgage-backed security isn't really a good bet right now. You have more people losing their jobs than ever. You have the government telling you that you can't foreclose on the property. So you're buying an asset that, one, the person likely is not going to pay you back on, and two, you have no way to recover the asset. So, I think just like any other business, it's really just going to take some time to get through this pandemic and get people back to work. I mean, that's the bottom line.
Yeah, absolutely. What do you kind of play Nostradamus here? What do you are there any other problems that you foresee coming down the pipe? And then maybe what are on a positive note, what are some of maybe the good things that you're seeing in the mortgage industry that are changing or will change as a result of all of this?
I think coming down the pipe negatively, there might be some more tightening of credit depending on how the loans are performing and depending on the numbers on the forbearances. So April is really the first month that we're going to be able to see how many people request a forbearance, how many people go into forbearance. So when those final numbers come out, it's going to give a lot of direction on how the market's going to react to it.
Yeah.
I think on a positive note, it's hard to put a lot of positive to it, but on a positive note, rates are good, and for the foreseeable future, they're going to stay low. A lot of things I'm reading are that they're going to continue to go down. So if you do have a job and you are looking to buy a home, or you have a current mortgage that's got a higher interest rate on it, people are going to be able to take advantage of the low rates. So obviously that's a positive thing.
Yeah, and hopefully they continue to stay low.
Yeah.
All right, my friend. Well, anything else, or I guess if somebody wanted to reach out, discuss their mortgage options, or talk to you about a refinance, where can they get a hold of you?
Yeah, my office line's 804-299-5408. Cell phone's 301-760-6899. Reach out anytime. I appreciate the having me on here, Chris, and we'll talk to you soon, man.
Yeah, absolutely. Thank you for your time, and we'll see you on the next one, my friend.
Thanks a lot.
All right, we'll see you, bye.